Morning everybody. I just thought I'd have a quick, try and email out a quick update, a market update. I'm away on a business strategy thing for a couple of days, but I am picking up emails and working, albeit in betweens. We've had a bit of a U-turn this morning, about a week ago's Friday's mini budget, and we've seen a scrapping of the 45% tax rule being abolished now. So there just seems to be an awful lot of toing and froing and not a great deal of confidence in what our new Prime Minister and Chancellor are actually doing. So the markets have reacted quite volatilely. We've seen quite a fall to, market was sitting at around 7,300, 7,200, quite happily, bimbling along through a trading range minding its own. It's gone down, and I've just seen this morning's opening was 6.8. Bit of a bounce back with the news that the 45% tax cut has now gone, so 45% tax is still going to stay there, but it just feels very uncertain and just a little bit of messing around in the economy. So what does this mean for you? Okay, those of you that are long-term clients, you know that we put in a market correction every 10 years in the Voyant chart. It accounts for this kind of thing. What I've also done at the beginning of this year is to go back and stress test your existing plans by increasing inflation and interest rates. So interest rates marginally, because otherwise it creates a benefit that may not there. Inflation, we've bumped up the assumptions quite high. Looking at most portfolios, anything that's not purely a bond fund. So the mixed, balanced and adventurous portfolios are holding up okay, given the amount of news that's going on. Proof fund is just bimbling along doing its thing. We may see a price correction there, but I haven't seen one yet. But there's probably still some upside for that one to be okay. The cautious funds are the ones that are taking the hit mostly, because they have a 40% allocation to bonds, and when you raise interest rates, the capital value of a bond falls. I'll try and put a bit more of an explainer video out about that, but essentially when the capital value of the bonds fall, a lot of those bonds are held in pension funds, the bigger group pension funds, and what you then see is pension fund assets being sold off because they still have the same monthly liabilities to pay out to their pensioners. And so there's a little bit of a vicious circle. Now the Bank of England stepped in and bought up an awful lot of bonds to stop that falling too far. Together with this, I'm going to ask Vicky to send this out today. She doesn't know it yet, but I'm going to send it to her just now. So maybe tomorrow it comes to you with a couple of charts and just a little bit of an explainer. Obviously, any questions, just drop us an email. The best place, because I'm not here, is into the team at email, and Emma will pick it up. Bear with, because we have a new joiner starting this week. So baptism of fire for her a little bit, but she's an experienced paraplanner, so that's fine. And I will catch up with you all soon, but yes, I will put together some notes and something to come out with this, but please, please call, please just check in with us to have a little look, see what yours is up to. All right, take care, talk to you all soon. Bye.